What is up, you guys? Welcome to the video. In today's video, we're going to be taking a look at what I believe to be a pretty shocking slash fascinating chart of the S&P 500 index. Now, if you're watching this video, there's a very good chance that you yourself are possibly invested in this index. It's one of the most popular investment options in the world. The S&P 500 contains 500 of the largest companies in America. Over the past 90 years, guys, it's achieved an average rate of return of about 9.8%. And after adjusting for inflation, which is something that I always like to do, I like to say it's right around that 7 to 8% range. It's a great investment option for beginners. It's a great investment option for more advanced investors. The S&P is a great way to invest. Now, the reason that I make this video today is not to scare you. It's not to tell you not to invest in the S&P, but I'm making this video to bring awareness on how the S&P is broken down. Now, as with many indexes, the S&P is what we would call a market-weighted index, meaning that as companies grow larger and larger, they're going to represent a larger and larger part of the index. Now, what we're looking at here is a breakdown of the S&P by company. And what this chart is telling us here is that the 5 largest companies in America, so the Apples, the Amazons, the Googles or Alphabets, Microsoft, Facebook, in other words, the FANG stocks, they have an equal weighting to the bottom 282 companies. So these 5 companies are so large that they have an equal weighting to the bottom 282. Now, what does this mean to us as investors? In other words, what should we be taking away from a chart like this? And there are multiple ways to view this, but let's start with the obvious. When you have an index that's skewed like this, the performance of the index is going to be very much driven by the larger components, the tech stocks. And looking at the past 3 years' performance for this index, we saw in 2016 up 11.96%, in 2017 up above 21%, and before the recent sell-off that we saw last week, I think the S&P was up something like 7 to 8%. Now, my question here is this a true representation of the US market? In fact, if we were to look here at the performance of the rest of the S&P, the index would actually be down if it weren't for these major tech companies holding it up, right? The FANG stocks that we're looking at here. To emphasize that, let's take a look at the company Best Buy, which has a current weighting in the index of 0.074%. Now, if this company were to, let's say, double, heck, if this company were to be a 10-bagger over the next little while, so outstanding performance out of Best Buy, would that have much of an impact on the index? And what this goes to show is that for a lot of these companies at their current weightings, it's almost fair to say that they're, pretty insignificant. Whereas a company like Amazon drops, 5 to 10%, well, that is going to have a pretty strong impact on the S&P 500. And you don't hear too many people talking about this, but as I touched on earlier, there is a huge amount of money flowing into these passive ETFs. Especially in the recent years, right? Index investing, passive investing is a very, very popular strategy. Now, when $1 is invested in an index ETF, it's used to purchase the constituents of the ETFs as of their current weightings, resulting in more demand for these higher weighted, higher priced securities. Now, this isn't always in your best interest because the result of this is you buying these higher priced, higher weighted securities when what we want to be doing typically is buying low. Sometimes we want to be buying these smaller out of favor positions. And when we have these large amounts of money flowing into these ETFs, an unintended consequence of that is that we're driving up the prices even higher of these already, high priced stocks. So like I said, it's not a reason not to invest in the S&P, but it is something to keep in mind. And to end this video and to kind of tie things all together and to talk here about, where the real risk lies to us as investors, we'll go over a little example that goes a little bit back before my time. It involves a company called Nortel Networks. And this was at the time Canada's largest telecommunications company. And what's so fascinating about this company is that as it grew larger and larger, at one point it grew so large that it represented 1/3 of the entire TSX index. In other words, if you were invested in the TSX index, 1/3 of your investments would have been concentrated into a single company. If you had your retirement savings, let's say you built up $1 million, you invested in the TSX, 1/3 of that, or $330,000, would have been invested in one company. Now, on January 14th, 2009, Nortel filed for bankruptcy. And like I said, this video is not to scare you, but to bring awareness to the breakdown of this index. You know, one of Warren Buffett's first rules when it comes to investing is knowing what you're invested in. And it really wasn't too long ago, during the financial crisis, that investors got slaughtered for not knowing what they were invested in. These new products, these bundles of, mortgage-backed securities that they thought were great investments, they ended up turning out to be junk. It all starts from knowing what you're invested in. If you enjoyed the video, feel free to give it a like. If you're not already subscribed to my channel, subscribe. I post a video every Monday. And as always, guys, I thank you for watching, and I'll see you in the next video.